Mike, last week we saw some pretty good news on the COVID front. Curves continue to go down. This morning, we see the president in reports from Financial Times talking about fast tracking some of the potential vaccines or treatment. Yet this market has not really been rallying the big reopening trades. It's still been all about tech. Is it ever going to change?
Well, I do think it'll change. I think there is a fair amount of pent-up demand from that perspective in terms of each time we see progress on a health solution, you tend to see markets rally. And I would suggest that if we look at things like kind of the consumer discretionary versus consumer staples equally weighted, it's on the cusp of a fresh relative high. And this would suggest to me, not only here domestically, but globally. So it's saying to me that investors are looking at an economic recovery. The industrial sector continues to outperform, particularly transportation, machinery, building products. You look at gaming stocks in China, they're doing pretty well. Copper. So I do think there's a evidence to suggest that investors continue to bet on an economic recovery if we can just find a solution to COVID-19.
So it seems like maybe with a few of these specific sector stories that we have to be wary about kind of painting with broad strokes, value versus growth, momentum versus growth. I mean, I know growth is generally you can paint pretty broad and you can win in that category right now. But as you mentioned, some of the building products, housing stuff that's tied to the housing recovery, that's doing well. Just on the flip side, it's like with rates pinned and banks stuck and financials stuck, it's just hurting that overall part of the trade. So how does an investor get exposure to potential recovery here without being pinned to one of these factors like value that just gets stuck every time?
So I think what's happening here is that the economic recovery is still likely to be uneven. So the labor market continues to rebound, but perhaps a bit slower than anticipated. I think the economic recovery is going to take a while longer. That's what the Fed continues to tell us from that standpoint. And I think as a result of that, investors continue to look for parts of the market that have solid organic growth rates, that can compound cash flows very strongly, and have structural advantages. And that all leads investors to continue to the technology front, consumer discretionary, where Amazon makes a big part, communication services. So I think that those parts of the market continue to demonstrate those characteristics at a time when many other parts of the market. So I think one of the other things that's interesting is that utilities have provided, a defensive sector, no relative advantage, even at a time when bond yields are declining. So it does suggest that markets continue to believe that the economy will recover. They're just kind of looking for those pockets of strength from that perspective.
I like the point about utilities, Mike, because for a long time they were a sure thing trade as well. And now we're looking at the chart, it hasn't moved basically since like April. Utilities tied to rates, and then this overall kind of everything rally that would happen in the market. You'd buy equities and you'd buy bonds. It seemed like utilities were in the perfect spot. They're equities, but they kind of trade like bonds. So what does it mean that this trade has kind of stalled out here? I mean, it seems like we're kind of sniffing onto something interesting here.
Well, I think that it continues to suggest that investors are expecting a recovery, albeit one that's uneven. So, and I think that's kind of where you're seeing some of the flow. So defensives, and most notably utilities, have not caught a bid, despite the fact that yields are falling, and the risks on the horizon are pretty, I don't know about knowable, but kind of there are a number of risks out there that continue to concern investors, yet the defensive parts of the market have not been able to kind of catch a bid at this point, which continues to suggest to me that it's this continued bifurcation between reliable growth in the tech space, and then when folks are feeling confident that an economic recovery is building, some of your more cyclical parts of the market.
Will the stall out that's happened in the utility space find its way in to some of the other, we'll call them asset classes that were part of this everything trade that do, though, want incremental Fed stimulus? It seems what we heard from the minutes most recently is that yield curve control is not as imminent as maybe some thought. We know that negative interest rates haven't been a part of the conversation now for a couple months as we've made the recovery. So should we eventually see some of those trades stall out? Gold, maybe even bonds, possibly, where the strength fades in some of these Fed-tied assets?
Well, I think what's going to happen this week is we know we're getting the Jackson Hole annual economic symposium. It's going to be virtual this year. There's going to be a number of speeches, not only by Powell, but by many other central bankers. And I think what you're largely going to hear this week at the symposium is how central bankers, and most notably the Fed, will continue to do whatever it takes to support the economy, the market, and the labor market. So I do think that there is an opportunity here for the Fed to perhaps soften some of the reaction to the release of the Fed minutes last week and continue to pledge support. I think the thing that's a bit unnerving is that the Fed is unclear as to what tools it may use in order to do that. As you rightly point out, it seems like yield curve control and negative rates are kind of off the table for now. And so what else can they do? I think they're going to continue to pledge support, most notably through very brisk purchases of all kinds of assets, credit in particular, as well as mortgages and treasuries will continue at a very strong pace, combined with very low rates.
Mike, do you need the Fed's actions to continue to surprise the market or be additive in terms of liquidity or any other real definition here? I mean, to help specifically the NASDAQ trade, how much of the tech trade is about valuation expansion that's either tied to lower rates or tied to money sloshing around the system?
I think that it's a big component of it, and I do think that what's happening is with rates being suppressed, with real interest rates being negative, again, those that are able to compound cash flows, have incredible organic growth rates at that time are likely to be rewarded, and they continue to be in that tech space. So I do think that the low rates, the Fed actions continue to be a major component to the technology trade, to the growth trade in particular. And it will likely continue. I mean, the Fed has basically suggested that they don't plan on raising rates until at least 2022. So I think that this will continue to be a major story for growth in particular and technology. And I think you and I have chatted about this before. I think the mechanism for value as an investment strategy to return is a pickup in real interest rate and a meaningful pickup in inflation and interest rates. And I just don't see that on the horizon in the next kind of 12 to 18 months.
And we had a pretty strong rebuke of that potential value trade last week. Mike, just real quick, is there anything else here apart from the Fed and the vaccine timelines and such that could be major market moves? It seems like we've tried to move past a little bit of the COVID-driven narrative. We've been talking China lately. Stories about trade have surfaced in the market again. Is there anything else we're missing here?
The one thing I would keep an eye on this week is in terms of the economic data, and I know you and Ben were just chatting about this before I came on. I do think we're getting both Conference Board consumer confidence as well as University of Michigan on Friday, and then also jobless claims and personal income. The reason why I mention this is because I think what will be interesting is if, in fact, this summer stall, this failure to replace income through another fiscal policy package begins to show up in the consumer, in personal income, where it's basically been a very strong support. So if that begins to falter, that could be a risk for the economic recovery. As you know, number of headlines this morning, there's a number of economists suggesting perhaps a double dip. I'm not saying that, but this data will essentially inform us, is that income replacement beginning to roll over? And if it does, it will have a pain point for consumers, which could cause some challenges for the economy.